On today's episode, we're answering 3 questions. The S&P 500 had a return of 25% in 2023. Where did that come from? Can you trick your brain into being a better spender? And what to expect from markets in 2024. Welcome to 2 Cents, where we help Dennis navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
It's a new year, guys. It's a new year. We're just,
It was me. I was a little slow on the uptake. It's okay.
It's the Christmas and New Year's hangover. It's the holiday hangover. So it's all good. Welcome to 2 Cents, guys. Excited to be back. Happy New Year to everyone.
Happy New Year.
Yeah, excited to be back. 2024, as we all said in one of the 2 weeks ago, pretty much across the board, how optimistic we are about this year. I think that's when you know we're long-term investors and financial planners, when we say we're optimistic. That's how we are every year. Okay, so let's jump into this. Rabih, the S&P 500, again, 25% return in 2023. I don't think anyone saw that coming, especially if we're talking like back in August. I know I was freaking out a little bit, fully admit it. I think today you wanted to kind of break down where this came from. This is a little bit of an extension of last week. We talked about this a little bit. But let's jump in of where did that return come from?
Exactly, because this is going to be the last week where we can talk about 2023 without having new information come in. So for the past couple of weeks, holiday, shorter trading weeks, the market was run by sentiment and by like what technical analysis says, because no new information was coming in. The Fed wasn't meeting. Earnings don't happen until like next week. So the market went rogue in a sense, and it was so close to actually breaking all-time high. Actually, at the peak of it, between Thursday and Friday, the market was only 0.5% below the all-time high on the S&P 500. Already hit the all-time high on the Dow, not yet on the NASDAQ, but on the S&P, it's right there. And the market didn't want to make it a big deal with no news. So I'm guessing we're waiting until next week and the week after when corporate earnings come up. And that might tilt us either in the direction of an all-time high, which is very bullish, or as the technical indicator people have been talking about lately, a 2-year double top, which I find very funny.
That's what I've been thinking about is, are we going to hit a 2-year double top? I've just been waiting for that, that iron condor double top, double dipper. It's just, that's what I've been really worried about,
Yeah, I'm just going to say I'm very glad for the efficient market hypothesis where, just looking at how the price is moving will not tell you anything about the future. I'm very glad for that.
Really quick before we jump into this, Rabih, and I don't want to jump ahead and steal Jake's thunder. So, Jake, if I am, I'm really sorry. But we've had 2 years in the last 3 that look no further as far as how market predictions just do not work. Right. So 2023, maybe just that year, just look at 2023 and tell me, how to predict markets. And then the other one is 2020. If you ever looking like that, 2020 obviously will be in the history books for various reasons, but specifically around the markets, to see what happened over like literally a 90-day period. Again, anyone that tells me they can predict markets, I just need to point to 2020, like spring of 2020, and then basically fall of 2023 through the end of the year. It's like there's just no possible way you can predict markets. Like no way.
Yeah.
I'm also thinking 2022 too, because it was like the worst year for bonds and no one predicted that.
There you go. Every year for the last 3 years.
Yeah, it's the only thing you can predict that there's something unpredictable that's going to happen. Like,
pretty much.
I think this is where we get stuck. So back to what I prepared, which was about the S&P 500.
Rabih's like, thanks, idiot. Can we get back to what I was talking about after you went on your soapbox?
No, that's not it, but that's Jake's segment. Let's leave those stuff.
I know.
For Jake.
I'm so sorry. I was stealing Jake's thunder. I'm excited, guys. It's January 2nd. I'm feeling jacked up on resolutions.
We're just having a discussion. This is great.
We're just chatting. Yeah.
Oh, now I feel weird going back into my stuff.
Why? Do it. Let's go.
I'm just kidding. The question is, so the market did 25%. where did that 25% come from? And I remember back in February when the AI craze started popping up, and all what we were talking about were like the Magnificent Seven. We're talking about NVIDIA, Facebook/Meta, Apple, Google, Netflix, Tesla, etc. And they were driving the market. So now after, 12 months have passed, are they the ones still driving the market? Like, so what happened? And I got some data that broke down the performance of the top 10 companies is in the S&P 500 and the remaining 490 companies in the index, in a sense. And the top 10 companies actually had a return of 62%. And the bottom 490 companies had a return of 8%. And once you average them out, they gave us a 24% for the S&P 500, 25 with dividends. So it's kind of so interesting because 25% is 25%, whether one company gave us that return or every company participated in that return, regardless. But that dispersion between the different companies, I think, highlights two main points. One, if you are aiming towards achieving proper diversification, it can be so sneaky, and you have to really look and dissect further to understand if you have a concentrated risk. And this risk is actually coming from those top 10 companies, because since data that we have from 1996, the proportion of these 10 companies out of the 500 companies in the index has never been higher. It's at 32%, and the highest it was lately before that, it was during the dot-com bubble, and it was around 26, 27%. So if you are really focusing on diversification, you have to look further, especially if you're in a direct indexing strategy, etc., because your top 10 stocks are very concentrated in the index from a historical perspective. The second point, if you're not looking at diversification and you are trying to come up with a narrative, you can either say, oh, those 10 players went up so much last year, they're going to go down next year. Or you can say, oh, the remaining 490 will now catch up and bring us a really good year next year. So,
or you can say, I have no idea.
Or you can say, I have no idea. So looking just at the return and breaking it down, it will not give us information going forward, but would definitely tell us about risk. It doesn't tell us much about return, but it definitely tells us about risk. And in a sense, look at other asset classes, look at other sectors, look at other styles, value versus growth, small cap versus large cap, international versus emerging. Just because stuff are going up, we've been going into 3 months of treasuries are up, gold is up, equities are up. It doesn't mean that
Bitcoin is up.
Bitcoin is up.
You get money for holding cash. You can make money anywhere right now.
Yeah. Exactly. This doesn't mean that you are still in a good risk position and you didn't drift away from efficient risk allocation. So I think this is a good opportunity to revisit portfolios, although they are up, just to look at the sources of risks rather than the sources of return, and to properly diversify.
I want to piggyback off that, Rabih, just really quickly, because I think this is an important thing. Matt talked about how hard it is to figure out what the market's going to do year to year, kind of on an overall, type of thing. But trying to pick individual stocks is even much harder than that. I think this thing of, the top 10 stocks are really they're accounting for all the returns in the S&P 500 really over the past couple of years, and they seem to only be getting bigger. I don't know if warn is the right word here, but historically speaking, it hasn't been this easy. Hey, just buy the top 10 stocks and in the most popular Apple, Microsoft, just buy those stocks, you're going to be fine. Historically speaking, once stocks get that big, they actually tend to underperform the market over a long period of time. It's just bigger companies only have so much that they can keep growing. Again, it's a weird market because this has not been the case the past 5 or so years. If you just would have bought Apple, Facebook, Microsoft the past 5 years, you would have killed the S&P 500, right? You would have crushed it. And so I think I just see a lot of friends and talk to a lot of people who are like, hey, I'm just buying the biggest 5 stocks and I'm just going to hold Tesla and just go with it. And I just feel good about myself. And I would just caution people that, yeah, maybe this has been the case the past couple of years. But as we know with the stock market, nothing works for forever. And there is like pretty substantiated data that shows these large cap companies, bigger companies, once they get to this bigger position that they're in, tend to underperform the overall market moving forward.
Well, to that point, that's a great point, Jake. And it's like, it's a masterclass in recency bias, right? It's like, it's really easy to look back and say, oh, well, why don't it's so easy. Why don't I just do this? It's like, well, yeah, anyone can look back and say, this looked so obvious. It's not, that's not the game. And to your point, Jake, if you actually do that, evidence shows that actually will lead to worse returns. Right.
You want to find the stocks. That's the thing. The biggest performing stocks are Apple 20 years ago, Amazon 20 years ago, right? It's the stocks that become these top 10. You want to hit them on that lead up before they become the top 10 is kind of where all the returns are at. But again, as Rabih said, this is like good luck trying to find those 3% of companies that end up, being in this spot.
Exactly.
But yeah, tough.
And the reasoning, back to Jake's points, really good ideas right here for why we expect companies that have performed really well, especially the largest companies in the economy, to underperform the market later on, is due to an upper limit on their growth. If the US economy is growing at 2% for 10 years, you can't expect all these tech companies to grow at 50% for 10 years, because at one point, they're going to become so big that they're going to become the economy. And you can't have an economy just based on one sector. This will revert back, fluctuate to a more, self-correcting market system. So the reason data tells us that on longer periods of time, those might underperform the market is simply because they have an upper limit called the economy that they are in. So here's why.
It's a great point. And Jake, coming back to what you were saying, is saying the best thing to do is to find the Apples, the Amazons, the Facebooks, the NVIDIAs of, from 20 years ago. We're going to do this. Actually, we've actually talked about this, to for a show.
We're going to find them and
we're going to do
them.
No,
tell you what they are for the next 20 years.
Yeah. Stay tuned. No. But we were talking about how so this is a teaser alert. We're going to go back and we're going to pick some of these stocks. And we're going to go back and actually give you the historical performance, like week to week, month to month, quarter to quarter, year to year. Because I've seen this in we've gone to offsite meetings and we've gone to these conventions, or conventions is a bad way to put it. Like the DFA, not a convention. What are we calling that? Conference, guys. Haven't been working for the last week. But we've gone to these conferences, right? And they've done this where they show you in real life and they cover the name of the company, right? And so we're going to do this. We're actually going to show you the actual performance and the significant drops they've had over time, because it's so easy to see the outcome and not understand the actual process. We do this with everything in life, but it's no more obvious than in investing, where we say, oh, I should have just put all my money, like the articles that say, if you would have just put in X number of dollars into X company 30 years ago, you'd be worth X number of dollars. They are the dumbest articles ever. They're not helpful. There's nothing helpful about that. And no human alive is doing that, because you have to sustain the ups and downs, the actual feelings of watching Amazon in 2001 drop 90%. So again, it's easy to say now,
or even just last year with a lot of these big tech companies.
NVIDIA dropped 80% in 2022.
Yeah. Just last year, a lot of these guys got hit a lot. So we always say, those top 10 got, what do you say, Rabih, 65% or something, this year. Yeah. But they're basically breaking back to even for their huge downturns last year, probably not even, right? So,
every single podcast in 2020, any investing podcast, any YouTube I watched, any article I read about anything in the tech sector in 2022, the sentiment was, it's over. Like the tech craze is over. Look at NVIDIA, look at Facebook, so again, I digress. We'll get into this on another show. I want us to really, when we bring this stuff up, I just always want to emphasize that Rabih said it, and we've said this so many times. The only two things you need to be successful with investing is proper diversification and time. That's what you need. And so what we're, go ahead, Jake.
it just feels like it's been a little too easy the past couple of years with these big stocks.
Yep.
Where it's like, it's just like, just put your money in Apple, put it in Tesla, put it in Nvidia, and you're going to get a huge return. That's kind of actually been the case, funnily enough. But I would just, again, like you said, Matt, recency bias, just if you're a long-term investor, you need to sustain this for decades. Nothing works for forever in the stock market.
Well, not only that, Jake, you said it, Rabih said it. There was nowhere you put your money this year that you didn't make money.
Yeah.
And it will never not be funny to me in 2023 that, Rabih, is that true? Rabih's questioning me now.
Volatility futures were down.
Okay.
Those are for retail investors.
Okay. When you have to dig into volatility futures, pretty much my statement stands that there's nowhere your money could go that you weren't going to make money. But again, that will never not be funny to me in 2023 when the sentiment going into the year and even throughout the year was that the disaster that was everything, according to every article, everything, and it ended up being the exact opposite across the board. Outside of volatility futures
and China, by the way,
and China. Okay. Outside of volatility futures and China, anywhere you put your money, including cash, to Jake's point, outside of a checking account, you actually made money. Mm-hmm. So that'll just never not be funny to me how the sentiment was so bad in 2023. Okay. We're moving on.
Yeah.
We're moving on. Okay. Let's I'm going to pivot here. Jake, do you want to jump into yours? Is it piggybacks off of Rabih's, or should we change it up with the little spending?
Let's change it up, then come back to me.
We'll come back. All right. So we're talking spending 2024. I think early 2024. It's January 2nd on this recording. It is the time of year for resolutions. It's the time of year that I hate going to the gym because all the people that are I love that people are wanting to get healthy. The Rabih, you're a dedicated gym goer. But it definitely gets busier. But one of the things, in fact, Fidelity they did a study last year, and the answer came out to be the same. The top 3 financial New Year's resolutions for 2024 remain consistent, and it all had to do with saving more, and paying down debt.
Awesome.
And then I think the other one was like, it's save more, pay down debt, and spend less, were the 3 that Fidelity did in 2023, and the answers were the same in 2024. Those are the top 3 resolutions. And so this article that I found, the title of it is trick your brain into being better with your money. And it was specifically around spending. And I thought it was interesting. I was like, this is actually something that there's 4 steps that they bring up that I want to see if this kind of test these 4 steps to see if we agree with how this would apply to dentists. So we'll just go through this. The number one step to trick your brain into being better with money, specifically around spending, is to simplify your bills. Jake, I know this is going to speak right to your heart. So we won't go into too much detail, but basically they're just saying simplify as much as you possibly can when it comes to your bills. Have your pay date on the same date. I'm going to take this further and actually say simplify your money as much as possible. Limit the amount of accounts you have, like 1 saving, 1 checking. Consolidate your retirement accounts as much as possible. I'm going to leave it there, Jake. I know you got thoughts on this.
I have one example for this that I think is a great example. If you dive into some finance blogs and things, if you own a house, right, you have your principal and interest payment, but then you also have to pay for insurance and taxes, right, on your house. This goes into an escrow account typically if you elect for that. You'll read some finance blogs and people who will say, why do you should not have an escrow account? Just save that money and then pay it every single year, like out kind of just out of your own pocket. And the reason for that is save it, put it in a high yield savings account, get some return, right? Keep it for yourself, optimize there. And I kind of don't love that at all. I have an escrow account. I understand that whole thing. I have an escrow account, but the reason I like it is it's paid every month for me. It's consistent. I know what it is. It fits into my budget. For me, that simplifies my finances. And
it frees up brain space.
Yes, way more peace of mind than me trying to get that extra, couple percent or whatever by keeping it in a high yield savings account. So that'd be my one example. Wholeheartedly agree.
Yeah. So to that point, Jake, I mean, we talk to hundreds of dentists every year. We have somewhere in the range of about 100 new clients a year, something like that. We talk to dentists all over the country. And when a client comes on board, we're always going through the onboarding process, and almost without fail, Jake, I want to see if you disagree with this, but from my perspective, I'd say 9 out of 10 times there is a pretty significant work to be done on the front end of just simplifying a client's life as we gather their
So many
data.
banking accounts. How
Oh
many
my
banking
gosh,
accounts
the
do we
number
see?
of banking accounts that we see from dentists on both the business and personal
Yeah.
side. And we always ask, hey, what's the reason for this? What's the purpose behind these accounts? And almost every time is, oh, I don't know. It just sort of like happened.
It's
like
an old one. Yeah, I'm trying to group this. I went with a bank and they had me open up 4 accounts, right? Types of things there. Yeah, it just gets out of hand.
Yeah, it's like, how do the clothes end up on my floor? They're not dirty for the hamper, but they're also not fully clean. So I'm not putting them back. Like, I don't know how it happened, but they're there. It's like the same thing with accounts. It's like they just sort of pile up.
Yeah.
And so I love this first step that this article references in simplify as much as you possibly can. Jake, I love what you said. There's this kind of the opposite of simplify. Most of the time is optimize. And I think we could talk about this on a different show, is like, what are things you should be thinking about optimizing versus simplifying? I think more times than not, you should be leaning towards the simplify. Rabih, I want you to jump in on this step if you have any thoughts.
From an investment perspective, usually the more complicated it is and the more they try to like optimize stuff, usually it's one with hidden fees and commissions and they try to go over your head. Whereas the simpler the investment, the better it is. And that's why no one beats the S&P 500 on the long run, because it's so simple and you just buy and hold. And yeah, simple beats efficiency or optimization between quotations, even investments.
Yeah, I love that. Okay, number 2. I actually really like this a lot. Number 2 step to trick your brain into being better with money is to set a financial health day. So basically, it goes on to say you should be setting up a day at some frequency to basically review your money, to review your subscriptions, to review obviously your net worth, to review your spending on a regular basis, where your money is going. Like, this is, so they call it a financial health day. I have thoughts on this, but Jake, I'll throw to you first. Just any of your kind of first reaction to that.
I did this last week. Funnily enough, I actually do this at the end of every year, where I go back through over my spending and kind of I'm kind of known as the anti-budget person, but I am big on knowing where your money's going, which I think this is what this is speaking to. So at the end of every year, I do go back and say, how much did I spend on utilities and bills and all my subscriptions and all this stuff? And I really just get to know where my money's going. We do this with our clients too, right? Kind of beginning of year, looking forward, we like to go and dive in and see where everything's at. So, yeah, huge proponent of it. And I really only dive in like once a year, big time, kind of on this holiday break type of thing. You could probably argue that you should be doing it maybe quarterly or even more frequently than I do it. But yeah, love it.
Yeah, I think it depends on what aspect of your finances you're reviewing, right? So, and your personality, right? Jake, to your point, like, you're anti-budget. And so you wouldn't necessarily, like, you've gone more of what we advocate for, which is like systematize your spending. You don't have to worry about budgeting, right? Which I'm
from this one. Yeah. So I review everything and then I automate everything, right? So automate the bills, automate savings, everything. And so the only time I update it is when income or different things change I have to account for. But my goal is can I set this on autopilot at least for the next 6 or so months, right?
Totally.
Goal.
Yeah. Again, you're trying to simplify, systematize, remove the burden of having to like emotionally be tied to this or mentally be tied to this, so you can focus on other things. I think that's the whole key to this. I think the other part of this is, you said it, we do this with clients. I think one of the values of having a money coach or advisor, or someone in your corner that you can trust, that's going to give you an objective view of your money. This is an underrated part of that. They're going to force you to, hopefully, if you have a quality person or quality advisor, they're going to force you to have these quote unquote financial health days. They're going to force you to review your net worth. They're going to force you to track to show you what your spending is and where your money's going and your investment returns. And I think a lot of times people finally work up the courage to talk to an advisor because they're like, I know I need to do this, but I'm not going to do this on my own.
Just the peace of mind that comes from just knowing where things are at is huge.
Huge.
Like, if you go over this little money health day, you don't even need to change anything just to see where everything is at. I go through this. I actually bring in my wife, who she doesn't love to dive into the numbers and things as much as I do, right? She's kind of like, I trust you, Anyway, I bring her in.
Big
we
mistake.
look over it.
Big
I know,
mistake there.
You can't argue. It's like, yeah. Anyway, I I bring her in, we kind of go over everything, and it's kind of a nice discussion. And it's really just, you almost feel like a weight lift. Just, I know for a lot of people who are stressed about money, a lot of it comes from just not knowing where you're at or what you're doing. And so just seeing where all your money's going and what you're saving, and you don't even need to change anything, but just knowing where it's at is very freeing, I've found.
I totally agree. Rabih, I know you're itching.
Yeah, no, what Jake said at the end was like hit close to home because when I came from Lebanon to the US, I think I did not go to a dentist for like a year and a half, 2 years. And I went there, and you always go into the dental office with like a little bit of shame,
It's
you
the
know?
worst.
It's like, oh, I haven't been there in a while. And the doctor was like, aren't you worried that something's happening, you know, between your gums, under your teeth, that you're not aware of, and like suddenly it's a bigger problem? And that same exact worry and fear is what I have when like I don't check on my savings or my portfolio performance every year or every year and a half. And it's kind of the same thing. It's just we worry as financial advisors about clients not doing it with their money. Dentists worry about their patients not doing it with their teeth. It's the same thing going round and round. Yeah.
It totally is. It's funny you say that, Rabih. We have a lot of parallels. Like our industry to the dental industry has a lot of parallels. You just named one of them. Nobody wants to do this. Nobody wants to go to the dentist, and nobody wants to talk to an advisor or review their money. But every time, to your guys' point, we see this. I can say this with almost 100% certainty, and almost 100% of the time. It's like 60% of the time it works every time, right? No, but it like almost every time, people, even if they know they're in a bad spot, they know they have a negative net worth, they know they're not where they want to be. Every time we actually get them organized and review this stuff, there's like this big sigh of like this big deep breath of like, okay, now we know where we're at. Now now we can go. Now we can start making progress.
When you go to your cleaning, you're like, oh, you have a cavity. That's kind of disappointing. But you're like, I feel good about it because I know I have it, and I know we have an appointment scheduled to fix it. And that feels great, right?
Yep.
So even it's like things don't need to be perfect. Just reviewing it is liberating. Yeah.
Yeah, for sure. The last thing on this that you already mentioned, Jake, they talk about having a spending date with your spouse or your partner to like actually talk about spending and make it fun, make it creative. Like,
tread lightly with this, I think. Honestly.
Yeah. Maybe tread lightly.
I just think this is not the problem with budgets, or where you can get into some issues is if you I could just see a spending date with your spouse going sideways. Could you guys?
Sure.
No? Right? Like where it's just like, it starts getting accusatory or something, right?
Well, that's okay. Okay. We're spending too much time on this than we should, but hopefully it's helpful. No, I think hopefully it's helpful. I think it's all in the way you frame it. So you have to know yourself. You have to know your spouse. And to your point, Jake, you've got to go into it with the right mindset. I do think it is something you should be communicating with your spouse or partner on a regular basis at some level of frequency. Once a year, a couple of times a year, once a month, whatever it is, it depends on your situation. But you do have to go into it curious, not judgmental, right? Not like accusatory. You got to be open, not accusatory. It's like we're here on the same page to like just understand where we're at financially and work together to improve and talk about our goals, our concerns, our values, not like you did this, you spent on this Chanel bag. Oh yeah. Well, you bought this. Like if it's going to be that, then maybe you need help outside of just having a money date. But you're right, Jake. It is all about the mindset and the approach that both people take. That just all comes down to communication. So, okay, we're going to blast through the next two so we can get to Jake's topic. The third one was make spending hurt. And what this was basically saying, and I totally agree with this, is, so for example, in today's age, obviously it has never been easier to spend. I actually think one of the reasons why consumer spending is like Teflon, we don't see it move, is because of how much technology, social media, the entire ecosystem is set up to make spending so easy. You look at just a simple example of Instagram. You are looking at someone you follow, some influencer, they post something about a pair of board shorts, whatever, insert something. All you have to literally, if you have your credit card saved in there, you swipe and click buy. It's that easy.
Yeah, numbers on a screen.
Yeah. Numbers on a screen. You don't feel the pain. This is credit cards. Amazon literally built an empire off of removing the friction from spending. This talks about how you need to make spending hurt, or another way to put that is put friction back in the spending process. If you're trying to be a better spender and more thoughtful with spending, remove your credit card from your phone. Like, don't have your credit card saved in your phone. Force yourself to actually have to go walk over and grab your credit card or use cash or whatever. So make spending hurt. You guys have any?
That's a Dave Ramsey take right there.
That is, yeah.
But I disagree. I don't like the use cash, because this goes against the thing of simplify your life. Like, when you're carrying cash and trying to figure out how much you spent, it's so hard with cash. With a card, it's easier. I'd rather keep paying with a credit card, but have a very clumsy wallet or something. Like, I don't want to deal with the money, because that takes mental space.
Totally. And I think you're right. I don't ever use cash except for after the holidays when I get like $50 from my grandma, which I did this year. Shout out Grandma Ann. But like when I have cash, like I rarely do. I'm with you, Rabih, but I still think the point remains and again, it depends on your situation, but it's creating friction where, like, strategic friction, I'll say. Like, I think having your credit card saved in your phone is always a bad idea, in my opinion. Always a bad idea. You will always spend more money when there is the less friction, the more you're going to spend. Like, that's just how it is. So, Jake, any thoughts on that one?
It's tough now. Consumer spending is crazy. Rabih talked about why did the market go up and why our economy is so healthy. I think
people just keep spending, baby.
We just keep spending money. If you look at airline prices and vacation, that's just consumer spending just keeps going up and up.
Yep, totally. The last one here on the spending front to trick your brain into being better with money is sweeten the small stuff. And I actually love this one as well. I loved all four of these, to be honest. But one of the lines from this is, you're not going to become rich by not buying lattes. And I love that, because the traditional financial advice is, oh, you spend $5 in a latte, you save that for the next 30 years. Like, look what happened. It's like, get out of here with that. Enjoy your latte. And that's what this is saying, is like, actually enjoy the small stuff. Like, I, for one, love my coffee, and I love buying small things or going out to lunch. I love that. It's like, focus on that. Focus on the big stuff. Let the little stuff go.
Are you ready for a confession? So as part of my spending review that I did last week, there's this taco truck by my house. Okay, that's awesome. They have like the best al pastor.
It's the only food you like, I think.
I love this place. Okay, I write a weekly newsletter, as some of you may know. It's kind of become a tradition for me that on the day that I finish the newsletter, I go get these tacos for dinner.
Love that.
I went 34 times last year kind of to this taco place. So if we kind of do the math, like, we're getting close to once a week, right? Or whatever there. It ended up being like $260 or something that I spent at this taco place last year. So if you think about it, it's like, oh, you went to this taco place 34 times, almost once a week. There are certain financial circles that be like, what are you doing? You should be not going out to get tacos once a week. But if you look like at the dollar amount over the course of a year, $250, $260, it's just not.
And how much joy did that bring to your life?
Yes, and it's great. And I went and I did it, and it was fun. And so it's like, if we look at the whole dollar amounts, this is my whole thing with people who try and buy like off-brand toothpaste for 30 cents less. When you get toothpaste once a month, it is like, that is doing nothing to your financial situation. Why are you using the brain space to kind of make those decisions? Anyway, I love my tacos. It was a big value out of my life for that $250 last year.
Totally agree. And only you can answer that, right?
Yeah.
So I'm all about remove the mindless spending. Remove mindless spending as much as you possibly can. The spending that at the end of the month you're like, well, where did my money go? I have no idea. Like, but even the small stuff that brings big joy to your life, like you're saying with the tacos, or if it's coffee or it's eating out with friends, go all in on that stuff. Enjoy it. Don't shame yourself and run a growth calculation on the opportunity cost of me not spending $17 at Chipotle today. Like, who cares? Enjoy that if it brings joy to your life. And again, you're not going to get rich by not buying lattes. Like, you're just not. Sorry. Rabih, any final thoughts before we wrap this up and get our last topic in?
I have kind of a quadrant in my mind on how I classify my spending. It's stuff versus experiences, of course, but also there's the frequency versus the magnitude in my mind.
Ooh,
So
I love this.
for goods, right, if the frequency of them is high, but they are small in magnitude, we're talking tacos or a latte, I will do these and not worry about them. For experiences other than goods, for experiences, I try to make this a low frequency, so once every couple of months, but big magnitude, which is like a good weekend getaway or a vacation. And that works out in the math. It doesn't affect my savings rate, but I still get both words, and I enjoy it.
Love that.
Studies actually show, Rabih, that small, more frequent splurges create more happiness than larger and frequent ones, funnily enough.
Yeah.
So yeah.
There you
These
go.
are those tacos, these are your lattes, these are your lunch with your friends, right? Those things actually create more happiness over time than your big vacation once every 2 years type of thing.
Yeah. Went to lunch with my friends today, talked to college. We were reviewing the college football games, talking about them, talking about the NIL, the transfer portal. We talked for an hour, and it's an investment in my mental health. I need that. My relationships, like I'm going to spend that money all day long, every day, not every day, but you know what I'm saying.
Yeah.
Love it. Okay. Jake, what to expect from 2024?
Just as a quick recap of 2022 and kind of what we were expecting for that, the S&P 500 was down 19% in 2022, right? And so when we were looking forward to 2023, there was a lot of doom and gloom about what would happen. We've talked about this. I actually had, like, historically speaking, the data said, like, trend-wise that 2023 would actually be pretty good. Did you guys know that if after a double-digit loss, like 19% in 2022, the market has only followed that up with another loss 4% of the time in its history.
Ooh.
Right? So it's very rare that there's a double-digit loss followed by another loss. And so if we look back, let's look forward. Like, okay, 2023 was the opposite. We had a huge gain, 25%. What does that mean for 2024? Kind of what can we expect there? Maybe you might be thinking, okay, well, the market seesaws back and forth. Maybe we should expect a down year coming in 2024. However, that's not really the case. The S&P 500 has been up roughly 55% of the time following a positive year. So you actually have, and this makes sense if you think about it, if you go back over the past 100 plus years or so of U.S. stock market data, the market's up about 3 out of every 4 years, right? It's kind of how the market works. And so returns come in clusters. They kind of group together, which may be counterintuitive, right? So there's just this graph. If you look at an S&P 500 graph of all the years, again, 3 out of every 4 years are up, and the good years tend to come in clusters and in clumps. And so, again, 55% chance of positive, historically speaking, that's what it's been. That's, not amazing, like overwhelming. Oh my gosh, put all your money into the market type of thing. But it's
keep investing. Just like,
yes, it's
keep investing. Yeah.
That's the point that I guess I want to get to here is no one really knows what to expect coming forward, right? We can look at all these historical market trends and what may happen, but the idea is no one really knows. The things that really derail the stock market are things that we're not expecting, like a pandemic, right? Might derail that. The funny thing is I always hear the news and people are like, oh, we got to be careful. Inflation's high. Interest rates are high. Gas prices are still high. This is going to cause a recession. Well, it's like we're already talking about those things. So that's not the unexpected thing. The market is pricing that in already. That's actually one of my theories of why 2023 we had a pretty good market year, is because there was nothing really big, world economic news that threw us off our axis, right? It was kind of everything was kind of expected or built in. And so, yeah,
there was scary things, but we all knew about them.
Yes, it's like we know the economy, high interest rates and spending and all this stuff, but it's like the all-knowing market, right? This is like the funny thing. Everyone makes a joke. Well, is it already priced in? What's priced in? What isn't priced into the market? So looking forward to 2024, there'll be a lot of prognosticators guessing about what's going to happen, what the market's going to do. We don't really know, but I would just say, like, just beware of all the people who are just still predicting recession. We're still waiting, right? It's like people have been predicting this for a year and a half, 2 years now. Still waiting for it to happen. I don't know if it's ever going to get here.
Yeah,
it's going to happen.
It's going to happen.
It's not going to happen due to high inflation, maybe due to high interest rates. And if a soft landing works out, maybe due to, supply chains. It's going to happen, but the reason is continuously changing.
Here's what's going to happen, Rabih. It's going to happen. And then every headline in the world is going to be like, here's why it happened. Yeah. We're going to explain it after the fact, but not one person living on the planet right now is going to be able to tell us when, how, and why it's going to happen.
The problem with that is, you could have said it was a reasonable take last year to be like, hey, we're probably going to have a recession. Like, you're not crazy for saying that. But if you would have acted on that and not invested your money, you would have missed out on 25% returns this year. That's the problem, right? So it's like you just have to keep investing because who really knows when it's going to happen. And if you kept investing in 2022, you got stocks at lower prices, and 2023 really rewarded you for investing.
And let's say this too, Jake. If you, from an investing standpoint, let me ask you guys this actually really quick. If you guys are both young pups, right? Young boys, young men, not boys, men, boys to men. Did you prefer 2022 or 2023 from an investing standpoint? Would you for the next 10 years, would you rather have, Jake, how old are you?
I am turning 30 this year.
Ooh, baby. Okay, Rabih,
Yeah.
You're also
27.
Oh my gosh, you're so young. Okay. 27, 30. For the next 10 years, would you take 10 2022s or would you rather have 10 2023s? And you guys are saving regular basis. Which one would you rather have?
You'd rather have 2022s because you're buying stocks at lower prices.
I love your trick question, Matt.
Yeah.
I'll give you a trick answer.
Leading the witness.
What's the answer, Rabih?
The trick answer is it doesn't only depend on how the market is moving. I get the logic that, yes, if 2022 is a down year, it's better to invest in it because you have a more guaranteed upside. However, the frequency that you are investing in. So if I'm going to get 10 years of 2022s, I'm only going to invest in the 10th year. But if I get a mix of 2022s and 2023s, I'll be spreading out the investment across the way to actually, because I can't predict when the low is.
Okay.
So the money.
Okay.
Yes, Rabih, what you're essentially saying is, yes, if you knew there was going to be 10 years of a down market, you would invest in the very 10th year. But that's the point. We don't know when the 10 years.
Yeah. Okay. Rabih, classic Rabih outthinks the whole room. I'm thinking theoretically from a general premise, and you're talking about frequency. I'm with you. I'm with you, Rabih.
So yes, you would rather want a down year to invest in it. But the reason I went through all this loop is just I wanted to connect it to what Jake was saying, which I found from a mathematical perspective, it's a very interesting observation, at least for me. Jake was telling us about statistics regarding if you invest at every single year and whether the previous year was up or down, you have a 55% chance if it was up the last year, or in general, it's a 70% chance that if you invest in the stock market, you make money in that given year, right? The interesting aspect, all of these are based on the frequency that you are investing at the beginning of the year. However, if you redo the experiment and you assume that you invest every February for 12 months, or every June for 12 months, or every September for 12 months, you are still going to get the same probabilities of 70%. You're still going to get the 9 to 10% annualized return on a long-term period. So the fact that it doesn't matter what frequency you're going on emphasizes that we don't know what's going to happen in the future and that you're not going to really actually get 10 years of 2022s. This is how I connected them together. Sorry to
No, I think that's an awesome point, Rabih.
Okay. Thank you for stealing the thunder of my general thought experiment. But
I want
sorry,
to
Jake, go ahead.
that. I actually think that's an awesome point where we use these arbitrary year dates for a lot of stock market data when
Yes,
they actually
it's
don't really
dumb.
mean anything. Where let's say this July you're wondering, should I put money into the market or should I not? Well, these statistics still stand. No matter what day of the year you choose to put money in the market, the chances are over the course of the next year, you have a 75% chance, historically speaking, of getting a positive return. And so that always stands no matter what market current you're in or what day you're investing in. That kind of always stands. It's not just these year dates, January to December. I think that's
totally.
Yeah.
Okay. Rabih, I everything you said was right and smarter than me. Okay. And I fully admit it. The general thought experiment was just saying, we get questions all the time. Jake just mentioned it. Is now a good time to invest? Should I be investing right now? You know, these types of questions. And they're asking from the standpoint of like, the market is scary or like what's going to happen right now in the market. And again, I think most people you talk to, a general investor out there, a general dentist, would say, like, if they look at 2023, let's say they're a young dentist, they're accumulating in their 401k, right? They're looking at 2023 as a better year than 2022. I'm just saying, generally speaking, meaning for them, for like their returns, they're like, oh my gosh, my portfolio is up, but they're continually investing. The counterintuitive truth here is that no, actually 2022 was a better year for you. You were able to accumulate far more shares in the market. Those little soldiers for you that are going to be growing in the future, you were able to accumulate more of those in 2022 than 2023. And so whenever people are freaking out about what's happening in the market and, oh my gosh, the market's going down, it's August of 2023 and things are, again, we keep trying to emphasize that's a good thing. If you've got a long time horizon, you want down markets, you want recessions, you want bear markets. Like you do want those things.
Yeah, you want them because 2023s are inevitable.
Exactly.
Like it's just going to happen. Like that, unless you don't think that, right? You could have the take that the government and the whole world is going to crap, and we're going to have a zombie
but
apocalypse.
if that's the case, then what?
And if
what
that's
are we
the case,
doing
you
here?
shouldn't be investing in the first place.
Yeah, we'll do a 2
that's the
cents
thing.
about it. Yeah.
Yeah. But 2 cents coming to you live from the zombie
From the
apocalypse.
zombie
would be really
apocalypse.
fun. Yeah, that'd be really fun. But yeah, the 2023s are inevitable. So that's when you have those 2022 years. When you're down 19%, it's like just keep putting your money in because you will be rewarded eventually.
Yep. Love it. Rabih?
Yeah, I agree with you guys because you guys aren't just giving out like rules of thumb. Like this is inherent in the math. Like the stock price right now is discounted future cash flows based on a certain discount rate. Lower current prices means higher discount rates, which means higher expected returns in the future. This is how the math works and how we price stocks all over the country, all over the world, actually. So when we say it's better to invest when prices are depressed, yes, it is. And this is the mathematical reason behind it.
Yeah. And I'm going to give you a spoiler alert. If you ask me, client or otherwise, dentist at a conference or on a phone call or a client in a meeting, and you ask me, is now a good time to invest? I will give you the answer right now. I will tell everyone the secret. Yes. The answer is yes. It is always a good time to invest if you've got future in front of you, if you've got time in front of you.
Yeah, but there are times that are better than the others. I remember in
Of course,
2022, it's like, hey, let's do a backdoor Roth conversion right now. The market's down 15%. This is as good a time as any to put money in, right? An extra set of that cash. So,
totally. Yep. Okay, guys, we threw a lot. That was a lot. We were feeling energetic. We were feeling spicy in 2024.
That's how we start the year.
This is how we start the year. We're sorry we went long, or we're sorry we're not sorry. Hopefully it was fun and helpful. Jake, Rabih, any final thoughts? Okay.
I love your thought experiments.
I love that you hijack them and go into deep detail about frequency of investing. That's my favorite. Okay. You guys are the best. Thank you so much for being here, Rabih and Jake. Thank you so much for listening. We are so excited for another great year, 2024. We're very optimistic about it. That was our 2 cents. There's only one thing left to do. That is go forth and live your rich life. Bye-bye.